Before April 1st, 2026, the RV market is changing in a few specific ways. Factory shipments are shifting, dealers are keeping lots tighter, used prices are settling into a more normal pattern, and financing is still a big deal. If you're thinking about buying, selling, or trading in, these 6 changes can affect what you pay and what you can negotiate. Here are the 6 things happening right now. Number 1. Shipment data versus the 2026 forecast. In the RV world, shipments usually means how many units factories send to dealers, not how many people actually bought at retail that month. That's why shipment numbers can look soft even when lots are busy, because manufacturers will slow production if dealers already have enough inventory. RVIA's January 2026 shipment report put total wholesale shipments at 24,683 units, down 10.7% versus January 2025. Towables were the drag. 21,614 towable shipments, down 13.2% year over year. Motorhomes were the bright spot. 3,069 units, up 12.7%. Inside that motorhome number, the biggest mover was Type C mini motorhomes, up 21.6% year over year, while Type B van campers were slightly up and Type A was slightly down. Park model shipments also increased. That mix is worth paying attention to. When you see Type C rising while towables soften, it usually points to 2 things happening at the same time. Some buyers are still willing to finance a motorized unit if it feels practical and mid-sized. And towable shoppers are staying extremely price-sensitive. It's not that towables are dead, it's that buyers are picky, and dealers don't want to overload on the same 2 to 3 floor plans if they're not sure the next wave of buyers is ready. Now, zoom out to the full year outlook, which is the bigger story going into spring. RVIA's Spring 2026 RV RoadSigns forecast still expects a mid-300,000 unit year, with 2026 wholesale shipments projected to range from 328,800 to 367,000 units, and a midpoint of 349,000.
RVIA noted this would build on 342,200 units shipped in 2025, which would make 2026 the 3rd straight year of growth. They're even hosting a webinar on March 18th to walk through the updated forecast. It's scheduled for 2 p.m. Eastern. What to watch before April 1st is how fast dealers believe the spring demand is real. If foot traffic and online leads look solid, you'll see dealers reorder quickly in the exact categories that are moving, especially compact motorhomes, lighter towables, and anything that hits a clean payment. If demand feels choppy, dealers will keep the lots tidy and let discounts do the work on slower inventory. Number 2. Lean dealer lots and a stronger used mix. Dealer sentiment coming out of late 2025 and early 2026 has a clear theme. Inventory finally feels more balanced, and most stores would rather carry lean through winter. In RVDA-linked dealer survey commentary, many dealers said inventory was about right for both travel trailers and motorhomes, with a preference to keep levels tighter until spring demand is obvious. That lines up with what major manufacturers have been saying as well. Thor has described dealer inventory turns as being at an appropriate level heading into the winter months. On the retail side, the big national dealers show how the mix is shifting. Camping World's 4th quarter 2025 results reported that same-store combined new and used unit sales increased, and they also reported market share at 13%. But the way they got there is the interesting part. Same-store new unit sales were down 5.3%, while same-store used unit sales jumped 14.7%.
Their notes about margins tell you why this happens in a payment-focused market. Used gross margin dipped partly because they accelerated sales of aged used units in December, basically choosing speed and cash flow over waiting for a slightly higher price. This matters because a lean dealer doesn't panic order as much. When a store is managing floor plan costs and trying to keep inventory turning, they stock what sells fast and they price the oddballs to leave. You also see dealerships putting more attention on service, parts, accessories, and finance and insurance products, because those areas can be steadier than new unit margins. If you're shopping before April 1st, ask direct questions that cut through the sales talk. How long has this unit been on the lot? Is it a prior model year? And what fees are truly non-negotiable? Also ask what the dealer can do after the sale, things like service scheduling, warranty processing, and parts availability.
In a market where dealers are leaning on fixed operations, a dealer with strong service capacity can be worth more than a slightly cheaper deal from a store that's booked out for months. Number 3. Price point engineering and spring deal tactics. One of the most important phrases you'll hear from the big manufacturers right now is targeting critical retail price points. Thor has said its motorized business is emphasizing the price points where consumer demand is currently concentrated. Winnebago has described its portfolio as being increasingly aligned with where consumers are spending, while also noting that dealer order patterns are seasonal and the retail environment is dynamic. Different companies, same message. Build what customers will actually sign for in this interest rate environment. This changes what shows up on lots. Instead of endless trim levels, you'll see more bundled value packages. Lithium-ready electrical setups, solar prep, upgraded insulation, or a nicer interior finish combined into one package that makes the sticker easy to understand. The upside is that entry-level and mid-range models can feel better equipped than they did a few years ago. The trade-off is that truly premium options can get expensive fast, and some brands simplify trims to reduce complexity and control costs. Right before April is also prime time for model year cleanup. Dealers still have holdover units that need to move before peak season, and manufacturers want dealers ready to accept incoming product without clogging the pipeline. That's when you'll see rebates, discounted packages, or dealer cash that gets translated into show pricing. A good example of how brands think about this period is the way manufacturers talk about spring show season and dealer events as moments when retail can pop, especially if buyers feel like pricing and the economy are stable. The smart way to shop is to focus on the full deal, not the headline discount. Ask for the out-the-door number with freight, prep, documentation, and any installed accessories included. If you tow, double-check the real weight numbers. Dry weight is not what you camp with. Look at cargo capacity, hitch weight, and the tow rating of your truck or SUV with passengers and gear. Also check the tires and axle ratings on the RV itself. Some trailers look light on paper, but get tight on payload once you add batteries, propane, water, and gear. This is where a deal can quietly turn into a problem if the numbers don't line up. Number 4. Financing pressure and the March rate decision. For RV buyers and dealers, interest rates aren't background noise. They're the monthly payment and the cost of holding inventory. The Federal Reserve's next scheduled policy meeting is March 17th to 18th, 2026. Even if you never follow finance news, that date matters because lenders price RV loans around the broader rate environment, and dealers finance their inventory with floor plan loans that get more expensive when rates stay elevated. Higher rates squeeze both sides at once. Buyers qualify for less,
and dealers pay more to keep units sitting. That's why you're seeing more focus on affordability, selective promotions, and sometimes longer loan terms. Some dealers will offer rate buy-downs, structured deals with bigger down payments, or lean on extended terms to land the payment. It can work, but you have to look past the payment and understand the total cost over time. A slightly lower payment on a very long term can mean paying a lot more interest overall. A simple checklist before you sign anything. Get pre-approved with at least one outside lender, like a credit union. Compare that with the dealer's offer. Ask whether the rate changes based on term length, and confirm if there's any prepayment penalty. Also, be honest about negative equity if you're trading in. Rolling debt into a new loan is one of the fastest ways to end up upside down, and it limits your options if you want to sell later. There's another timing factor in March that dealers pay attention to: tax refunds. Dealer survey commentary has called refunds a short-term tailwind for discretionary purchases like RVs, especially in entry-level categories. It doesn't mean everyone spends a refund on an RV, but it does mean dealers tend to push hard on promotions and payment-friendly messaging as spring approaches. Number 5. Used values are normalizing, and buyers are getting more specific about what they want. The used RV story in early 2026 is less about chaos and more about normalization. NPA's January 2026 pre-owned RV report said normalization is nearly complete, with wholesale values lining up more closely with historical depreciation curves. They also said values for travel trailers and fifth wheels could see a modest 1.8% month-over-month increase tied to dealers restocking ahead of the spring surge, while motorized values were expected to be relatively flat. They added a very practical detail. Buyers are favoring smaller, fuel-efficient Class B camper vans, and those units continue to command a premium in the resale market. Their February 2026 report kept the tone steady. The market remains stable, inventory levels and prices are still elevated, and buyers are cautious. They pointed out that demand is centered on quality, affordability, and access to attractive financing, which makes pre-owned inventory especially appealing right now. For dealers, their strategy recommendations were blunt. Prioritize late-model trade-ins, especially 2022 and newer units, and price aged pre-owned units aggressively instead of letting them sit. They even called out factory-style tech like lithium power systems and solar integration as features people will pay extra for because it feels more ready to camp without immediate upgrades. For shoppers, this is where the opportunity sits. A well-priced used unit can mean a smaller loan, a more comfortable payment, and less depreciation shock in the first year. The risk is condition. Before April 1st, when a lot of people start buying fast, take the extra step. Check for water intrusion, inspect the roof and seals, test every appliance, and confirm the age and condition of tires and batteries. On motorhomes, pay attention to both sides of the vehicle, the drivetrain history, and the house systems. If you can, get a professional inspection, because one hidden leak or electrical problem can erase the savings of buying used. Also, don't skip paperwork basics. Verify the title status, check for open recalls, and make sure the VIN on the paperwork matches the RV itself. A good deal is only good if it's clean and supported. Number 6. Tariffs and material costs are shifting again, and RV pricing can react in indirect ways. A lot of RV components and raw materials are global, and even one input can matter if there isn't an easy substitute. In late February 2026, RVIA published detailed updates on tariff changes and timing. One key point is that a temporary import duty under Section 122 began being collected starting February 24, 2026, with uncertainty around whether the rate stays at 10% or moves higher. RVIA highlighted Luan plywood as a specific concern for RV manufacturing because it's widely used, it's primarily sourced from Indonesia, and there isn't a domestic plywood substitute with the same weight and structural properties. Their update explained that because Luan plywood wasn't listed in the relevant exemption annexes, it would be subject to the Section 122 tariff rate. This isn't just theory. Major component suppliers are also openly saying that tariffs and higher steel, aluminum, and freight costs show up in their world as higher material costs and pricing pressure. Lippert's parent company, LCI Industries, said its 2026 outlook assumes North American RV wholesale shipments of 335,000 to 350,000 units, and it referenced existing tariffs in its guidance while describing how material costs have influenced selling prices. Why does this matter before April 1st? Because when input costs jump, the first reaction isn't always a clean sticker price change. Often, it shows up as fewer factory incentives, tighter allocations, or a slower pace of discounting on new orders. Units already on the lot may be priced under older cost assumptions, while special orders and incoming shipments reflect the new reality. If you're shopping right now, the practical move is to ask whether the price is locked for the specific stock number you're looking at, and whether any market adjustment language can appear at delivery for an ordered unit.
It's also a good moment to budget for ownership costs that can rise quietly, like replacement parts and service labor. When the supply chain gets more expensive, it doesn't just affect the RV you buy, it can also affect what it costs to keep it running. That's why March pricing can change fast.